We have with us today Mr. Sanjeev Chadda, the Managing Director and CEO of Bank of Baroda, and he is joined by the bank's EDs and the bank's Chief Financial Officer. We start with brief opening remarks by Mr. Chadda. We do have a brief presentation for you, and we'll follow that up with the Q&A session. Over to you, sir.
Thanks very much, Firoza, and a very warm welcome to all of you. Great pleasure to see you after a long time. I think it's 3 years since we met in person. So thank you again for taking the trouble. Let me just begin by introducing my colleagues, with many of whom you might be familiar. So starting on my right, we have Mr. Ajay Khurana, who looks after retail for us. To his right, we have Lalit, who you might be seeing for the first time. So Lalit was heading our US operations and is now handling our international operations and also a lot of our platform functions, including HR. To my left, Mr. Divya Chand, who is handling corporate and also treasury for us. To his left, we have Joydeep Datta Roy, who looks after digital, IT, and also wealth, right? So subsidiaries for us, right? And to his left, you have somebody with whom we are most familiar, Ian D'Souza, our Chief Financial Officer. So I'll just again make a small presentation, not take more than 10 to 15 minutes, and then open up to questions. Try to make sure that I cover enough ground so that some of the questions which we anticipate are addressed, and then we can take it from there on.
Yeah. Can you have the PPT, please?
So thank you once again. We'll just start with the first slide. Yeah, so I think I just want to hark back again to the beginning of the year. So we had started the year by saying that finally it might be possible this year for us to actually both grow our book and also to have our margins. The last few years were a challenge. There was a choice either to grow or to retain your margins. And this year you will find that we have delivered largely on both counts. If you look at loan growth, it continues to be robust at about 20%. The good news, of course, is that now this seems to be spread pretty evenly across segments. There is no segment which is not growing in double digits. The standout performance is, of course, in retail, where organic retail growth is 30%. There, the slowest growing segment is home loans, which is now growing at nearly 20%. And unsecured personal loans, of course, are growing much faster. This is something which has positive implications for the composition of the retail portfolio and also for yields as we go ahead. Now we have reached the stage where unsecured loans actually are contributing significantly, even in terms of composition to the retail portfolio. They still are a relatively small piece for us. And I believe that this is something which has scope to grow at almost an equal pace for a few more years before the growth really moderates. If you look at the right-hand slide, you will find that the disbursement growth is mostly significantly higher than the overall growth. So I think that would again augur well for the sustainability of this growth in the future. What has worked well for us is that the gap that you see with most banks between deposit and loan growth is relatively small for us. So overall deposit growth is 17.5%, which is just a little bit short of the 20% in terms of loan growth. And if you look at the domestic piece also, there again, it is 14.5%. That has meant that the CD ratio for us continues to be moderate. In fact, the CD ratio now is not much higher as compared to what it was 3 years back. So which means over a 3-year period, the loan growth and deposit growth roughly stacks up. And it means that it is possible for us to continue to grow for some time our loans at a pace significantly faster than our deposits. Yeah. So because of the fact that we have been able to grow loans significantly faster, and most of the growth has come from the retail segment, where you have got good pricing upside, margins continue to strengthen. We had guided last quarter that our margins were a bit overstated, and they ought to be again about 3.17% on an adjusted basis. So if you see that, then our margins have improved by 20 basis points over the last quarter. Now, this is because you find that the gap between yield on advances and cost of deposits is still there, about 20 basis points this quarter. It was about 40 basis points the previous quarter. It's about 20 basis points plus now. And I would believe there might still be a quarter or so when we can still profit from the lag effect between the repricing of loans and deposits as we go forward. In terms of profitability, you would find that the biggest jump has come in terms of net interest income, which is a logical corollary of the fact that our loan growth is about 20%, and there is a margin improvement along with that. Fee income is a bit tepid because in terms of private sector capital investment and term loans that come on account of that, that is still not where it would be when the cycle is completely back, and that should improve as that improves. You'd also see that there's a third column in the operating profit growth and the profit after tax. There were some one-offs which were there. The operating profit difference is largely because of certain security receipts from ARCs, where the treatment recommended by the Reserve Bank has changed, and therefore provisions which were there above the operating profit line have come below the line. And therefore, the increase in operating profit on adjusted basis is about 37%. On the profit after tax, it is also on account of the fact that there were some one-off tax provisions which were made, which meant that our effective taxation rate was a little high as far as this quarter is concerned. But the good part is that if you look at the last line, it would seem to suggest that we should be able to sustain this improvement as we go ahead. The 9-month profitability again demonstrates that what we have seen in this quarter is not necessarily again one-off, and we have seen a full 9 quarters of significantly improved performance. All of this again, the fact that you had profits to make sure that your balance sheet is strengthened is again reflected in the asset quality. So on the one hand, of course, the credit costs has come down substantially, much lower as compared to what we anticipated. This is because the corporate credit cycle is possibly in the best place possible. All NPAs are fully provisioned, and also on account of the fact that there were enough profits to take care of any requirement that might have been there. So I would believe that we are now at that stage where we can again look at the existing book and be reasonably reassured that there are no downsides there. In terms of sustainability of this improvement, to my mind, this is the slide that would give us reassurance. Now, for the last 4 quarters, the SMA position continues to be very stable and improving. So therefore, I think there's nothing as of now on the horizon which would suggest that there might be any serious issues with impairments or asset quality as we go forward. And the collection piece again is something which is now stabilized at a very high rate. Because of the strong internal accruals, the bank's capital position continues to be good. You would normally have expected with a 20% loan growth, there might be a requirement for external capital infusion. But the fact is this, that even with this loan growth, the internal accruals are so strong that we will end up with a capital adequacy ratio at the end of the year, which is better than what it was at the beginning of the year. Now, if we were also to suppose that there might be some moderation in loan growth next year, and also that this kind of internal accruals should sustain or improve, I think the bank is in a good position to also sustain its growth through internal accruals in the coming year too. So as of now, we do not believe that there may be a reason for us to approach the capital markets, excepting, of course, for the fact that growth is much, much faster as compared to what we anticipate today. Last couple of slides again, we want to discuss again where do we stand vis-a-vis again peer banks. So I think there's a cyclical upturn which has benefited most banks, but I think there are also some factors which are particular to Bank of Baroda. Largely it stems from, I think, how please go back to the previous slide if you don't mind. Previous slide. Yeah. So largely again, they stem again from the bank's own position. So what you would see is that our physical build actually again has not expanded. So the number of branches are much lower as compared to what they were 3 years back. Number of employees are lower, but there is very robust growth that we have seen. And this growth in some ways is understated because we had 2 years of very low growth. Now that we are growing at 20%, and let's assume that that trend continues, and also the physical build also is largely where it was, you will see that there is an expansion of margins because finally we have been able to really sunder what was the symbiotic link between costs and also in terms of revenues. So I think we should see an expansion of margins on account of the fact that we probably would be able to contain costs better than peer banks. Some of the impact in terms of what we are talking of is already visible. I mentioned that our deposit growth again is probably better than peers. So if you take the average of the top 9 banks which have declared results, our deposit growth is 3 percentage points higher. Advances growth is also 1 percentage point higher. So this should again translate into sustained outperformance. Again, moving on to profitability, whichever measure you look at, as compared to the same set of 9 banks, private sector and public sector, we outperform competition by a significant margin mentioned on the slide previous to the previous one, which is in terms of costs, where the gap between the cost, the OPEX increase between us and peer banks is the widest. Our OPEX is increasing at half the rate, right? And as again, this current growth that we have seen, it sustains, you will see it getting reflected in profit margins even more as we go forward. Before I close, let me again address one question, which I believe otherwise might come from multiple sources. That is again our exposure to a large group, which again has been under discussion. So I'll just put 2 or 3 factoids before you. I normally refrain again from talking in terms of specific accounts, but I believe you have a legitimate right to ask questions about our portfolio. So I'll talk about it in the context of our portfolio. So in the context of our portfolio, this particular group exposure does not figure among the top 15 by way of, again, exposure to groups as per LEF norms. Now, as you are aware, LEF norms by the RBI take into account outstandings, they take into account non-fund based limits, and they also take into account also undisbursed loans, right? Based upon the LEF norms, the group does not figure in the top 15 large exposures of the bank. That is factoid number one. Number two, as per the LEF framework, you can put out a certain percentage of your capital to a particular group. What we have put out is about 1/4 of what we can as per our capital, right? So that again would give some reassurance. Third, of the exposure that we have, 30% is either in joint venture with a public sector company or is backed by a guarantee of a public sector company. So therefore, I would want to again give you that comfort and reassurance that whatever you have seen in the previous slides by way of performance, by way of profit trajectory, by way of credit costs is likely to continue regardless of the circumstances that we see either in the context last few days or in the next few months. Thank you very much.
Thank you, sir. We are now open for questions. If you have a question, please raise your hand and we will get a mic to you. If you can please limit your questions in the first instance to just one or two, and we'll come back to you if we have time. We also have a few people on Zoom, so we'll take a few questions from here and then we'll go to Zoom as well. We also have if you could just before you ask your question, if you could just briefly introduce yourself. Thank you.
Thank you. I'm Ashok Ajmera. I'm the chairman of Ajmera. Sir, thanks a lot and for this last clarification. Because State Bank is too far and it's your own or bank. So, sir, having said that, yeah, you have given some clarification, sir, but especially in this kind of situation, which are absolutely extraordinary situations, most of the banks are giving little more information. So as to, yes, this is they are not under top 15. But in the absolute terms, if we can talk, say like Punjab National Bank has given 7,000 crore of exposure and 6,000 crore of outstanding. And how much percentage of you said 1/4 of your tier 1 capital? But it's not true. Yeah. So can you
not 1/4 of tier 1 capital. The Reserve Bank of India allows you to lend a certain percentage of a tier 1 capital. Whatever is the maximum allowed by Reserve Bank, it is 1/4 of that.
the 2.5%.
अब आप देखिए मेरा
okay.
हिस्ट्री इन कॉलेज मैथ्स मेरा कमजोर है तो इससे ज्यादा फिगर मेरे से ना पूछें आप.
So it is better to give some numbers also, and especially the undisbursed, I mean total exposure as well as the outstanding and how comfortable going forward.
So I think the fact is that this is the beauty of the LEF framework, and we must compliment the Reserve Bank in terms of how it has been devised. That this takes care of everything that you're asking, right? What is the current exposure? What is the non-fund based exposure? What are the undisbursed limits? All of these are factored in, and on that basis, again, the Reserve Bank of India asks you again to limit your exposure. So all these things are there. I think the rest is very frankly a matter of detail. I think what is of interest to you and everybody else is that could there be any future impact on the bank? क्योंकि ultimately ये जो हमारी interaction हो रहा है ये बैंक के बारे में है ना?
Yes.
तो आपको ये समझना है कि बैंक पे इसका क्या असर पड़ सकता है. तो what I can assure you is that from the figures that I have given you, they should give sufficient reassurance that the kind of trajectory that you have seen from the bank in terms of improved performance that will be sustained. There's nothing in terms of this exposure that can have any significant impact on that.
Okay, sir. How much percentage of your total credit the exposure to this group?
How much? देखिए फिर मैं कहूँगा ultimately.
All right. I give a pass to it, sir. Thank you, sir. If you look at your composition of the credit book now, recent latest. 57% is and 43.3% is corporate.
Indeed.
So going forward, corporate is started growing faster with a greater speed now. What do you think should be the ideal competition in the times to come? The current quarter, everybody maybe another 2 or 3 quarters. 40, 60, whatever.
Yeah. I think it's a very fair point, and we have been conscious that while it's a very good time to be a corporate bank, but corporate banking does again experience cycles, and when those cycles are there, the impact on the bank is very large. So therefore, a granular portfolio is something which is to the benefit of the bank. To my mind, if we progress towards a 60-40 proportion, that might be a good place to be in. We have been guiding that whatever our growth should be in line with industry or better. B, of this growth, we would want our retail to grow at 1.5x. So which means that if we want our growth to be at 15%, retail should grow at 22%. And corporate should be 0.7x. So that while you take full advantage of the opportunities in corporate, at the same time, you are able to progressively achieve a change in the portfolio, which will mean that the kind of returns that we are seeing are sustainable.
Sir, one point on recovery and another one on treasury.
Indeed.
Just a small 2 questions. On the recovery front, so I think you slowed down in this quarter. If you look at numbers, more, sir, Khurana, sir, that where do you stand on the recovery front? Because upgradation is also less. So going forward, I will.
Yes, actually, as far as overall general normal run rate is concerned of recovery, it is all the same. In fact, it is little bit improvement. But that is one case in our international book, which got upgraded and with some recovery. That is why that we can see the gap between the last quarter and this quarter. Otherwise, our run rate is improving month on month.
Sir, anything on NARCL front? How many account? What is the amount, gross or the net or the realization, and looking forward in the next quarter?
No, NSCL, so far, whatever they have identified and they have gone, only one account was there, and that too we don't have there. But in other accounts, the progress as of now seems like that anything will be in this quarter.
Sorry, so we just have to.
Just on one treasury. Pressure on the market and something treasury income has gone down as compared to the sizable profit in the last quarter. And if you look at the segment also, so can you just treasury book and how do we I mean, similar expectations.
There are 2 aspects to it. One is with regard to the interest income on treasury, right? So if you look at the book increase quarter to quarter and year to year, my income growth has been higher than the book increase. So in a rising interest scenario, typically this is the best case scenario where I can generate more income than what I put money in terms of investment. So that has seen a significant increase in terms of the interest income on investment. The second aspect is with regard to the valuation scale. So as far as on the valuation side is concerned, on the overall book, we are rather there is a write back. But there was one investment where there is a treatment in terms of pushing that from above the line to below the line. So because of that, you are finding a release and the treasury income is getting influenced by that. So otherwise, we are perfectly, the book is doing extremely well and they are quite good in terms of increasing income at the same time containing any MTM impact going forward. With regard to overall outlook, what we see as of today is that globally also here in India, if you take OIS as a proxy, possibly the levels are elevated. Now it is picking out in that way. At the same time, there is a reversal also people are looking at because 5-year OIS is less than the 3-month or 6-month OIS, right? And the US also the curve got inverted. So there may be some kind of a reversal happening possibly the end of this financial year. So in that prognosis, the book looks quite good and the impact also quite manageable.
What is the modified duration in the?
My AFS is 1.79. AFS is 1.79.
Thanks, sir. We just take a few online questions. Sneha, hello. Maruk, I request you to unmute yourself and ask the question. Maruk Ajajania, please unmute yourself and ask the question. Go to the next question. Yeah. The next
Hello,
question is
can you
from-
hear me?
Yes, Maruk.
Yeah, hi. So, my first question is, so when you talk about capital tier 1, it's the standalone capital, right?
Is it standalone capital?
Hello?
Maruk, I request you to speak your question in full.
Yes, hi. So when you're talking about exposure limits, you're talking about standalone capital, right?
So we are talking in terms of how the Reserve Bank of India defines that, right? So that would be in terms of a tier 1 capital.
Tier 1 standalone capital.
Standalone capital. Okay, sorry. Pardon me. Yes.
Okay, thank you.
The next question is from Adarsh. Please unmute yourself and ask the question.
Yeah, sir, I just Adarsh from CLSA. So you adequately answered. So the 25% of what was allowed under LEF takes care of undisbursed limits, non-fund exposure, overseas exposure as well. Is that a correct clarification, sir?
That's correct.
Okay. And sir, one more thing. Just wanted to check, right? One is about Adani being a group and lending to a particular group, right? I just wanted to understand there are various related parties, some SPVs around related parties. Just wanted to check if you've lent to any of them that would be part of this exposure, if at all.
So I think I mentioned to you again that 30% of the exposure is by way of joint ventures, again, along with the group, right? Also some which are guaranteed. So all possible exposures which can be clubbed in group exposure have been taken care of.
Perfect, sir. And so I just wanted to understand now, the second question was on margins. The sector has seen a very strong improvement in margins. Next year, obviously, deposits will catch up. It's a little bit of a fight for gathering deposits. So with our loan mix improvement, assuming some normalization in credit growth, what will be a fair sense of a sustainable margin for the bank, and just to be a little bit on the conservative side?
Yeah. So I think where we are now, I think seems to be a sustainable level. As you said that there is some benefit that we have received this year from the fact that there is a lag effect between the repricing of loans and deposits. That is already diminishing. I mentioned in my opening remarks that was 40 basis points difference was there. Now that's come down to 20 basis points difference. That will also vanish over a period of time. But I think that when it comes to our book, there are some positives that should continue to protect us. Now, one is, as we discussed at the beginning, the changing composition of the book, right? The fact that retail loans are an expanding proportion, and retail loans actually are benefiting from the change in interest rates very substantially. That is going to be right till such time that we actually go back into another cycle. That might be some time off. Within that, the composition, I think, is again something which is important. So you see that unsecured personal loans now are a very significant proportion of the retail book. It was almost nothing. Now it already might be 15 to 20% odd, right? Which is there. So our total unsecured personal loans are about 15,000 crores plus probably. So I think that is, and there's scope for this to improve. So I think the upside that you will get in terms of margins from the rising proportion of retail loans, and within retail loans, the rising proportion of unsecured loans, I think should help in margins as we move ahead. Third, in terms of the repricing of the corporate portfolio, that is still in process. It is still in process in two ways. One is loans which are benchmarked to 1 year MCLR, right? Over a 1 year period, they get repriced. So that is improvement that will continue for some time. The second part is that still, again, you find that most investments are coming really from the largest groups who have great pricing power. So you're not still fully able to price again the new rates when it comes to lending to the best corporates. This, of course, augurs very well for the quality of credit. But in terms of the benefit of rates, I think it will continue to be in the corporate segment in the next year.
Got it, sir. And when you say sustainable margins, you're referring to the 9-month number.
I'm referring to the 9-month number. This is not very different from the quarterly number. So I would venture to say the quarterly number also.
Perfect, sir. This is super helpful, and thanks for the clarification on the group. Thank you, sir.
The next question is from Kunal Shah. Please unmute yourself and ask the question.
Yeah, hi, sir. This is Kunal Shah from so firstly, when we look at it in terms of the overall corporate credit, significant part of it, almost like 2/3 of it is coming from lending to NBFC, almost 20 or 1,000 kind of increase in this particular quarter itself. So are these a short tenor, long tenor, and we have given some qualitative aspect with respect to NBFC, but do we expect the rundown also to come through in this book, which will have some pressure on corporate credit?
So I think what you probably asking, I think your voice was a bit distorted. So let me just repeat what I've understood. I think what you are saying is that how sustainable the corporate credit growth might be, because there might be some short-term loans, which again might actually run off, right? I think that's what I understood.
Yeah.
So to my mind, actually, we are, and we have tried to be fairly strategic about it, right? We are conscious that liquidity is still shrinking. Pricing power is likely to move in favor of banks as we move forward. Therefore, where you are getting the kind of pricing which you believe is very fair, regardless of where you are in the liquidity cycle, that would be something where you might want to make commitments which are longer term. Where you believe that still pricing power is not fully with you, right? And with certain sets of borrowers, that will be the case. You would want to make sure that that exposure again is capable of being repriced as you move ahead in the cycle. So there will be some short-term exposures, but we see it again more as strategic intent to fully profit from the interest rate cycle.
Sure. So, and given the environment, how are we seeing the pricing on the corporate side? Is it like it is the competitive pressure has eased off, or it is still equally competitive, say with the rating profile which we are doing on NBFC side?
So every quarter is better than the last quarter.
Okay, got that. And secondly, when I look at it in terms of the retail term deposits, in fact, that's down on a quarter-on-quarter basis. So again, what would be our strategy in terms of trying to, I think major part of the deposit growth has come by building up the bulk deposits over here. So what would be the strategy in terms of mobilizing the retail people?
So ultimately, you want to manage your costs to make sure again that you maximize this time period where you are actually getting some kicker from, again, the pricing differential. And also you would want to protect yourself from the possibility that the present spike in rates may not be a permanent increase in rates. Therefore, if you look at what is the published highest rate of the bank, right, which you might see on the billboard when you drive through Mumbai, it is 399 days, 7.8% to our senior citizens. Because we believe that we can be fairly sure that for next 12 to 15 months, rates might be where they are, but there may be a possibility, just when we talk of, again, the Reserve Bank of India possibly reappraising rates maybe a year from now, there could be a possibility that retail deposit rates, also the current, again, trend might again reverse or get stabilized. So therefore, you find that growth is coming A, from this deposit scheme that we have talked of. B, it is coming again from wholesale deposit, but also coincidentally are a maximum of 1 year, right? So what we are trying to make sure again is that we do not commit to the bank to an interest rate cycle about which we are not confident today. And as we move forward, there may be again enough confidence for us to broaden the time segments where we believe we have fair visibility of, again, stable rates. If you again go back to 2 or 3 years back, most of our growth again came from long-term deposits, 3 years, 5 years, because we believe that was a good time to lock into longer-term rates. So effectively, this works pretty much in a deliberate manner to make sure that you take into account the uncertainties of the future, and you also make commitments to the extent that you have visibility.
Sure. Thanks. Yeah, that's very helpful.
Thank you, sir. We'll take the question here from the gentleman.
Manoj Alimchandani, at the outset, great transformation since last 5 years. and done very, very successfully. And you are being benchmarked among the best private PSUs like Indian Bank, Canada Bank, PNB, and among the best performances to date. Hats off to you and your whole team. Now, a couple of very specific, very, very important questions. We have seen in the last couple of days major development, particularly the finance minister's speech on giving a major, biggest impetus to infrastructure. It is being titled as a capex budget and the largest boost by government spending, 4.9% of the GDP. Here, a bigger push is required together, private public sector, which has been mentioned. So how do we see in this bank the push to infra lending? And would it be among the all-time highest growth, particularly in FY24, because that is being addressed pre-election, because it has to work together. And how do we see the risk management framework? Because infrastructure is, we have to take long-term needs, short-term needs, short-term in terms of last mile funding, the finance minister talked about for closure of over 100 projects. And also long-term sustainable development, which takes about 15 to 25 years. And the risk management framework, looking at the asset liability mismatch also because of the period. Of course, 1 year will be could be a walkthrough. And the risk assessment in terms of cash flows and business groups. And we have to address this. It gives us actually a tremendous opportunity. How do we look at it? Number two is the boost to savings which has come, particularly in the last 2 days, the new default regime. The new regime become the default. So after a long time, the banks have got what they wanted, level playing field. So those ATC and all, suppose those are not discouraged. Finance Minister talked about 35,000 crores boost to savings. And do we see a big impetus to deposit growth because of that? It's an opportunity we have to strike from day one. How do we see deposit growth, particularly in post new default regime of income tax? It gives us a great opportunity. Number two is particularly, we talked about a few quantitative indicators like return on equity. How do we see? Because we are looking at the peer banks here, of course, SBI results also, I think you will be seeing closely that was missed out in the industry versus BOB. And the other banks, could we achieve a ROE of 20% soon? And we see a lag in the results. You are given very good NIM growth and operating profit growth. Your lending also, but the fee-based income is lagging behind. Normally, it goes hand to hand. So, were there any particular issues, and how do we intend to correct it in this coming year? And what we are looking at it in this particularly year?
The first aspect you talked about the capex-led budget and our role therein. So if you look at the infrastructure, our growth in terms of the industry growth has been the highest, right? And particularly two sectors doing extremely well. One is the power sector and secondly the road sector, right? And going forward also the kind of budget that we had where there is a substantial push for infra, and we as a bank typically mimic the economy, right? So in that way, the more the growth on the infra side, the bank would be again growing on those sectors. And the book is quite long and its outlook also quite long in infrastructure, right? On the second aspect that you talked about with regard to on the retail, on the money be available in the retail masses and whether that will lead to a deposit growth. It can be two. Yes, it can lead to a deposit growth or can be a consumption led, which is good for my normal loans, all my retail loans and all. So overall, we are quite positive both in terms of the outlook of the budget and that has the impact on the economy. At the same time, specific to two of our points like infra, yes, we are going to be long. With regard to the retail deposit, yes, it is going to supplement the retail deposit. Similarly, also the retail advances also, because that would consumption would lead to more create some demand at the lower level, and that would also would be good for my book in that way. I hope I answered all your, because it was a long question in that way.
Yeah. So one more, a very important thing on the deposit side.
Yeah.
In the last couple of weeks, we have seen a major private bank, the 6, come out with a very good product which they have been marketing aggressively since last a couple of weeks. A repo link product where they are giving interest rate of over 8%, 8.3%, and which we wonder what they are doing. Fantastic repo link product, and that type to certain class of depositors. So how do you look at such products? And these are very innovative, and this is what the market wants, particularly in terms of volatility in interest rate worldwide, which has become the norm actually now post COVID. And do we also looking at such a product, whatever is the interest rate we'll offer for any category? And what you feel could be the market size of such repo link products totally?
See, it's a broader industry level issue, because you are talking about a floating rate deposit as compared to a floating rate advances, right? So there will be a market for that. Earlier, these banks used to offer a MIBOR link product also. But then these are more for a product with the institution than the retail. That is what our earlier experience is. So we'll just map it out, and if there is a requirement, we'll have a look on that. But currently, because product per se, but there is a floating, like our deposits are typically up to 1 year, right? So it gets reset at the end of 1 year. So the requirement of resetting, the liquidity, everything would be mapped out, and we need to see that market developing. Although on the loan side, these are all floating rate, deposit side should be with floating rate deposit, but then you need to see the market on that.
Thank you.
Thank you, sir.
Wishing you all the best.
We have one question, I think, at the back.
Thanks for the opportunity. Samir Vise from JM Financial. Just one question to Mr. D'Souza. Can you just explain the provision right back and the
Yeah. So there was a recent circular of RBI that required security receipts above a particular tenor to be provided as loss assets. So we are already carrying provision for the security receipts, but they were being held as part of the revaluation provisions, which we actually reflect above the line. So in this quarter, we reversed those provisions and we provided for them in the below the line in provision for non-performing investments. In addition, there was a one-off investment for which we took provision. So the net of the two is what you see there. And on PNL, only the impact is about 632 crores.
Yeah.
So because one is a reclassification.
Sure, thanks. And secondly, on the personal loans book, Anissa said that obviously this will continue to grow at a very healthy pace. Can you share some details on what could be loans to existing customers of the bank? What is the sourcing in terms of some digital partners or that's all. Thank you.
So currently, the entire book, almost entire book, is existing bank customers, right? We are considering that we should look at, now that we have some comfort with the product, that we might look at new to bank customers for the simple reason that what is your existing customer, right? A customer for whom you have data which you can analyze, and on that basis you can take a decision. Now that distinction in terms of data availability is potentially shrinking. Once you have comfort and confidence that you have a similar quality data available for a non-customer, you might want to diversify that portfolio. But for the moment, nearly 100% of the portfolio is of existing bank customers who have accounts with us, and then you can analyze those accounts and then make them offers in terms of the kind of exposure you can take on them, and also at what kind of rate. I think this is something which could grow again for some more time at a fast pace, because even for us, I think the current book might be, given the size of the bank, probably a fourth of what is the potential size if you would look at peers. So that's why there's some runway there.
Thank you. We'll take a couple of questions from the online audience, please.
Thank you, sir. Saurabh Kumar, I request you to please unmute yourself and ask the question.
Oh, thank you, sir. Sir, two questions. One is on this large group, have your team has been able to do any credit assessment over the last week? And so could you share your thoughts as to what is your view of the credit of this group and any latest assessment that you've been able to do? Second is, what is the total pool of restructured assets and the provision you carry now on the same? And the third is on the OPEX, is there any wage revision you have done, provision for wage revisions you've done? Thank you.
So we'll go in the wage revision. Yes, we have made the provision which has been required of us with effect from 1st November. Right. In terms of the large group, I think, as I mentioned, that for all our large group exposures, we try to make sure that it is as diversified as possible. In this case, also, this would be spread over a number of companies, maybe a dozen of them. Also, I mentioned to you again that a significant proportion of that is in joint ventures. Also, I think there is nothing at all which would seem to suggest that any operating company we should have any kind of issues. As I mentioned, we are at the most comfortable time in terms of the corporate credit cycle. The environment is very comfortable. Third, in terms of where the bank stands, I think in terms of the corporate credit cycle, I don't think anything for us to worry about. I would only want to reassure that both in terms of this particular exposure and also in terms of the corporate book in general, we are likely to continue to see the improvement that we have seen in terms of lower slippages, lower credit costs, and therefore more and more of the operating profit getting reflected to the bank's bottom line.
Thank you, sir. The next question is from Jai Mundra. Please unmute yourself and ask the question.
Yeah, hi, sir. Good evening. So firstly, on this large group exposure again, if you can sort of specifically mention the exposure through bonds, right? So what you have mentioned is the total exposure. Could there be significant difference between exposure and outstanding as of third quarter or later? And what could be the bond exposure? Could it be like negligible bond exposure, or there could be still some sizable bond exposure?
So again, I think we are treading into territory which I fear to tread upon, right? Because at the end of the day, we'll be getting into specifics. What I would want to again say is that, look, at the end of the day, we are here to analyze the possible impact of this or any other development on the bank, right? I don't think there's anything which can significantly alter the trajectory we have seen of the bank. And all the questions that you asked, there is nothing in any potential answers which would give you any discomfort. Let me put it this way.
Sure. Understood, sir. And secondly, on I think CFO sir mentioned that this NPI and the MTM reversal in the other income. If you can quantify the the nature of this NPI, I mean, which was one-off, which was the usual NPI, and the rest would be security receipts. And what is the PCR on security receipts now?
Yeah. So first, let me just, I think, first refer to Kunal Sahab. I think there was a question that you asked on restructured loans, right? I think which I omitted to answer, and then we'll pass it on to the CFO.
Yeah, restructure. I think previous there was a question. Total book is 16,700 crores, and provision that is 2,000 crores.
Yeah. Okay. And
Yeah. So the provision for the NPI that we took incrementally this quarter is 632 crores.
That is the usual non-performing investment, not the security receipts, right?
No, this is for the investment. The security receipt reclassification was 680 crores.
And what is the PCR now on security receipts, sir?
It's 100%.
Sure. 100%, right? Yeah. Okay. And last question, sir. If you can share the loan book by benchmark, I mean MCLR base rate, MCLR, EBLR, fixed, etc.
Yeah. So the MCLR is almost 50%. In terms of EBLR, it's around 30%. And we have a very small proportion of 6-7% fixed rate. The remaining is floating rate, but benchmark to rates like T-bill and etc.
Sure. Thank you and all the best, sir.
Thank you. Do you have any questions here? If you can give the mic.
While you indicated that we are not having a very on the rate cycle, which is why we are raising bulk deposits. But the is like almost 100% YOY. So any threshold that you would like to maintain, the competition for deposits is only going to increase. And what's the
So I think this is what you normally see, right? Whenever interest rates go down, the first thing that you pay off is your bulk deposits. And that's what you would have seen also if you were to analyze our books last 2-3 years, that is what you might have seen. And again, as they move up, this is possibly a way of ensuring that your marginal rate in what you pay is a little different from what you might be paying on the portfolio, right? That it makes sense to do that. Now, as again, that difference between the marginal rate and the portfolio rate narrows, it probably will make a lot more sense to actually start focusing on the other part also. So I would believe we might reach that stage sometime in the coming financial year.
Right. And secondly, sir, again on the large exposure, so not looking for any data point or as such, do you think that there can be any refinancing risk which can come through and the risk will eventually devolve onto banks? Because a large part of the exposure is outside the banking loans. It's through bonds and the other ways. So that if that doesn't get renewed, so that eventually devolve onto bank. Do you think that is a possibility of that?
So I look again at the end of the day, we can only look at our own books, right? Given where we are in terms of point in time. To comment anything beyond that, I think it's just possibly not, and it's not feasible. When you look at our own books, I would only say that look, our books are not related to anything which has changed over the last few days. We lend on the value. There's a leverage ratio that you accept. There's a certain cash flow that you accept to make a credit. That leverage ratio has not changed. The equity that we have assumed, again, that equity value has not changed by paisa. So therefore, as of now, I would believe that there should be very little reason. Also, whatever independent committee that we have again heard, none of it would suggest that any of these things should really become a problem. So I think we are where there's a lot of noise which is there. That noise is something that impacts certain parts of the financial sector more, certain parts less. I would believe that structurally, given the nature of the issue, banks are likely to be the least impacted. At least we are very, very comfortable with our own portfolio.
Sure, sir. And so lastly, on the while you talked about the wage provisions the bank has started making, have you also worked out the linked pension liability and what are the plans to provide for that?
Ian?
Yeah, are you talking about the family pension liability or are you talking about the wage arrears?
The pension in respect to the wage hike, potential wage hike.
So as of now, we have started taking progress for the estimated wage hike. We will in the due course look at the pension also, the possible pension.
Sure. Thanks, sir. Thanks.
Thank you. We'll take a last couple of questions. If we have anybody here, others will go to online. Okay, I think we can ask a couple of our online participants.
Harshvardhan, I request you to please unmute yourself and ask the question.
Hi, sir. So regarding the large group exposure that we're talking about, just want to confirm that this includes the investment book in the domestic and international entities, right?
Confirmed.
Sure. Thanks a lot, sir. That's all.
The next question is from Rakesh Kumar. Please unmute yourself and ask the question.
Am I audible, sir?
Yes, you are.
Yeah, thank you, sir. So just one question with respect to loans proportion on MCLR. So have we increased the proportion on MCLR or in coming quarter or so, are we further going to increase the MCLR proportion to enhance the margin?
Yeah, that's a, if you look at the composition, Means prior to that, there was a bigger component in terms of external linked benchmark under the corporate, like T-bill link or the GSEC link. So now it's happening to MCLR. So going forward, the component would definitely go up.
Sir, just a related, thought. Would not the regulator wish to, discontinue the MCLR, and is there a possibility that the corporate loans also being benchmarked to, some external benchmark? Is that a possibility in the near future?
No, we have no idea. Currently, the regime is MCLR that is continuing. So absolutely no idea, right?
Okay. Thank you, sir.
And even as Chansab said, the choice is available to the borrower, right? That what is the benchmark they might choose. So even today, the choice is there, and ultimately the borrowers will determine what banks do.
No, but sir, in the case of floating rate loans in the retail and MSME, we are mandated to give loans on EBLR. So if there is a similar kind of guideline coming from the regulator, then we don't have any option.
Yeah, as per the regulatory guidelines, we have to act on that. So as of today, we have no idea.
Got it. So because maybe after some time, not now, we will stabilize the interest rate, and then we will set into the declining rate scenario. So and MCLR will help us in that scenario. But if there's a change in the regulatory guideline, then situation can be different.
You are right. Absolutely, you are right on that.
Thank you, sir. Thank you.
The last question is from Adarsh. Please unmute yourself and ask the question. Adarsh P, you're requested to unmute yourself and ask the question.
We have somebody here, otherwise we could.
If you have the last question, please unmute yourself and ask the question.
Okay, we'll just take one last question from your Sneha, and then we'll close. Yes, sir.
Hi, sir. Thanks for the opportunity. So just one question. Sir, as we are seeing that 4Q, because the kind of the QQ margin expansion that we are seeing, probably there's another quarter where some bit of margin expansion, but FY24, whereas your cost of funds will catch up. But can we say like an FY24 margin would be closer to the average of the full year of FY23 because of the product mix improvement towards unsecured and some bit of retail share improvement can drive that? With the margins for a full year for FY24 would be closer to the average of what we are able to deliver on FY23?
So I think really we're getting into speculation. I can only say that we have tried to exercise discipline even when the environment was unfavorable to make sure that we don't compromise on margins, right? So now that when the environment is more favorable, pricing power has finally returned to the banks in some measure after 3 years. I think particularly in the corporate book, which is nearly 45% of the book, I think there is scope for some expansion in margins there. That will flow on account of two reasons. A is because, as was mentioned in the previous question, there's a normal cyclical play out of the MCLR, which will continue to happen. Number two, as I mentioned, there are still large groups which have great pricing power, great bargaining power. I think to some extent, there's still a bit of a regress of balance, which is likely. So I think we remain fairly confident that the improvement in margins that we have seen should continue. Certainly where we are, maybe some scope for improvement as we go ahead.
Yeah, sure. Thanks.
Thank you. Yes, I'd like to now invite Mr. Ian D'Souza to please give the vote of thanks.
So good evening, everyone. Thank you all for making it to our first physical event in over 3 years. It's a real pleasure to see all of you here. For all of you who participated online, thank you as well. If there are any further questions due to our paucity of time, we couldn't address them, please reach out to me and my team. Happy to interact with you offline. Thank you so much.
Thank you. And please join us for high tea. It's on the third floor itself.